Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hi there and welcome to The Global View on this Friday morning. It's nice to be here with you. I'm Nadine Blaney. All right, a surprisingly strong U.S. jobs report helped lift sentiment, with investors seemingly unperturbed by dwindling chances for a rate cut this month, instead relieved that the U.S. economy is holding up. Those are record highs for the S&P and NASDAQ on screen, with both markets notching a third week of gains. U.S. markets, as you know, are closed for Independence Day on Friday. The Dow was up by 0.77%. Trading volume was a bit lighter ahead of that long weekend. Nvidia rose closer to that $4 trillion valuation, rising 1.3%. It's set to overtake Apple as the world's most valuable company. TripAdvisor rocketed after the Wall Street Journal reported that Starboard Value, an activist investor, had built a 9% stake in the company. Lucid shares rose after it reported a 38% jump in quarterly deliveries, and Datadog shares jumped with the cyber firm set to join the S&P 500. RBC lifted its price target for defense stocks, citing AI and missile growth, although didn't lift them all. But copper miners fell after strong U.S. jobs data, including BHP and Rio Tinto in New York. Well, U.S. President Trump's tax cut, and spending bill narrowly passed through Congress. The bill will add $3.4 trillion to U.S. debt over a decade and push millions of Americans off health insurance. It will also fund his immigration crackdown, make 2017 tax cuts permanent, and deliver tax breaks promised in his election campaign, amongst other things. Now, to that jobs data, which pushed markets to record highs, the non-farm payrolls came in unexpectedly hot, with 147,000 jobs added in June and the unemployment rate falling to 4.1%. Now, the non-farm report followed conflicting data from ADP, which showed private payrolls unexpectedly falling in June, the first drop in more than 2 years. Wages growth also slowed. Atlanta Fed President Raphael Bostic says rates may need to stay on hold for at least a year. He also said he only expects one interest rate cut this year. Markets are now pricing in a September start to rate cuts and 2 quarter-point cuts by the end of the year. In other economic news, the U.S. trade deficit expanded in May because of a jump in imports. U.S. importers may be stocking up ahead of a possible increase in tariffs on the 9th of July or August the 12th. The U.S. 10-year and 2-year yields rose after the jobs report, with the 10-year yield jumping from 4.26% to 4.35%. The U.S. dollar advanced against major currency pairs. The Aussie dollar had a volatile night. It's now sitting at 65.8. Bitcoin pushed a bit higher. Now, commodities reacted to the surprise jobs number as well. Copper, as I mentioned, fell by 1.1%. Iron ore rose 1.5% to $96, and gold fell 0.9% on expectations for a later rate cut in the U.S. Brent crude oil futures fell 0.3% to $69. Investors are worried that U.S. tariffs could slow energy demand ahead of an expected supply boost. Well, for more on what moved markets overnight, I caught up with Fiona Cincotta from Citi Index a little earlier. We began by discussing U.S. jobs data and, of course, that record finish in the U.S.
Yeah, this was really interesting because I think the lead indicators heading into the release actually did point to potentially a weaker than expected data print. And the fact that we had that strength in the head count, the actual headline number at 147,000, significantly ahead of that 110,000 forecast. But we also saw that dip in the unemployment level. So that does point to some, strength and resilience in the labour market. Now, I think, the fact that we saw wage growth at 0.2%, so just slightly lower than expectations, down on previous months, does suggest that potentially this could be sort of like that Goldilocks type figure where we're not necessarily seeing very big sort of inflationary impact, but we are seeing the resilience necessary for for the Federal Reserve to be comfortable potentially with cutting rates further on in the year. But I think it definitely does remove that any expectations of a July rate cut from the Fed.
Yeah, so we saw equity markets rallying, I suppose, just on the relief that the U.S. economy is not worse than expected. What does this mean for the U.S. dollar, though, in your view?
Yeah, so that's an interesting one. As you said, we saw those stocks hit record highs again on that relief rally, actually, that things aren't that bad, because obviously there has been a lot of worries that the US economy is going to be hit, or was going to be hit, will be hit by the tariffs, but it's just not quite showing up in the data just yet. But as far as the US dollar is concerned, I mean, you know what, the US dollar is still struggling around those 3.5-year lows. And whilst the data, was okay in the sense that it wasn't going to really cause big losses for the US dollar, it's certainly not enough, I think, to support the dollar, because it does sort of suggest that the Federal Reserve will be cutting interest rates. There's nothing in there to be really too concerned about adding inflationary impact, as I said. So in that respect, I think there is a potential that we're going to see continued weakness in the US dollar as we move across the second half of this year. Obviously, the first half of this year has been a very weak start for the US dollar, the weakest first half for the dollar since 1973. And I think a lot of those factors are going to be sticking with us as we go through the second half of the year. And we've just seen this pivot away from the US dollar. Investors are showing signs that they really are keen to be diversifying into other areas in their FX portfolios.
So we could talk about the big, beautiful bill, but what's there to say? It was approved by the House. I'd like to take things to politics a little bit closer to home for you. Now, we didn't do a lot of a dig into this, but it looks as if the pound and bonds in the UK recovered after your Prime Minister Starmer looked to back his Chancellor. Break it down for us. Why should investors care about this?
Yes, it's been quite a volatile couple of days for the pound and for the UK gilt market. Basically, what we've sort of saw happen was in a Prime Minister's question time yesterday, the Prime Minister, Keir Starmer, failed to really confirm that Chancellor Rachel Reeves would be remaining in her position for an extended period of time. Now, literally, as he sort of failed to back her, you could see the gilt sell off, you could see the pound sell off. And what was the worry here was that a replacement to Rachel Reeves may not stick to fiscal rules as closely as she is actually doing. Now, why is this important? This basically just highlights the fragility and I think of the concerns that there are regarding the UK's public finances. And this all came sort of after a welfare bill. Actually, there was supposed to be some welfare cuts. They didn't actually get pushed through to the extent that was initially planned. So that means that it was going to be costing more for the government. So even these little changes that we're seeing, which actually mean that her headroom has now been wiped out, are just enough to create quite big concerns in the market. So what we've learned from this today, when Keir Starmer did back Rachel Reeves, and we saw that recovery in the pound and the recovery in the gilt market, is that the gilt and the pound do actually like Rachel Reeves. They like the fiscal rules that she has, but also that there is a very fragile balance here. And the government does have to be careful, because if they go towards a level where they're going to be spending too much, then we could quite quickly see another strong reaction in the gilt market, which is a problem for the government, because obviously if gilts go down, yields go up, and that means that borrowing is more expensive.
Yeah, and we've seen what's happened in the past when the bond market has reacted to what's happening in Parliament. All right. So just before I let you go, if I'm a trader, I'm thinking of risk events on the horizon, and I'm thinking about July the 7th, when we get the expiration of this so-called tariff deadline. That would be the big risk event next week, you think?
Yeah, I mean, this is a big event for next week. I think the problem that we're having is traders are finding it very difficult to really price in what this is going to mean. I mean, as far as deals that have been done, there are a few that have managed to agree a trade deal with the US and get it over the line. However, there are a lot who haven't, including some very important trading partners such as Japan and the EU. Now, I think the reason that the market is sort of really just having problems being able to assess what this deadline means is because of uncertainty over what Trump's actually going to do. Will he extend the deadline? Will he actually implement the deadline? Will the reciprocal tariffs be brought in? Will it all get pushed back? There's so much uncertainty that I think it's quite difficult for the markets to be able to put a price on that, and to be able to sort of really take into account what it might mean. And I think that's why we might see potentially, that the market isn't necessarily pricing in, I would say, the worst case scenario at all. I mean, we've got US stocks at record highs. So there almost is this sense that the market's a little bit blasé about what this date could mean. Hopefully that means that, Trump isn't going to take too many drastic decisions on that day. But yes, that is going to be the big one for next week, especially given that we've got a relatively light docket as far as the economic calendar is concerned.
And Fiona was very kind there not to correct me. The deadline for tariffs is actually July the 9th. I can't seem to keep that straight in my brain. My apologies. All right, let's take a look at what the SPY futures are predicting for this local market, up by 27 points or 0.3%. So likely we'll be testing record highs here. In fact, I had a conversation with Henry Jennings from Marcus Today, who reckons that's exactly what's going to happen when this market gets underway in just a couple of minutes' time. Andrew Gagan will take you through the first hour of the open next.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.